All right, let's get right into it. Today, we're going to look under the hood of the market, into its plumbing, to find this powerful and honestly mostly invisible force that can seriously move prices around. If you're an analyst, this is something you've got to know.
You know, it's not always about some big news event or a shocking earnings report. A lot of the time, the real story, the thing that's actually driving the price action, is buried deep in the mechanics of how the market itself works.
And to really get our heads around this hidden engine, we have to start with the people who keep the whole machine running, the ones providing the liquidity for all of us, the market makers.
Now, here is the one detail you absolutely have to remember about market makers. They have a critical constraint. They aren't trying to predict if a stock is going up or down. In fact, they're required to stay delta neutral, which is just a fancy way of saying they can't have a directional bet. Their entire job is to avoid exposure to price moves, and that right there is the key to everything.
So this mandatory need to hedge, to constantly rebalance their books to get back to zero exposure, brings us right to the heart of the matter. A concept called gamma exposure, or GEX for short. Okay, so let's break that down. If an option's delta is how much its price changes when the stock moves, then gamma is how fast that delta itself is changing. So when the public, that's you and me, are all piling into one side of a trade, say buying a ton of call options, the dealers are on the other side. This forces them into a really unstable position, a state we call being short gamma.
In this chart, wow, it just lays out the problem perfectly. When dealers are short gamma, which you see in all those red bars, they're forced to do the exact opposite of what would stabilize a market. To get back to neutral, they have to sell when prices are going down and buy when prices are going up. It's called procyclical hedging, and it's a huge deal.
So let that sink in. The very actions they have to take to reduce their own risk end up pouring gasoline on the fire for everyone else. Their hedging doesn't calm things down, it actually makes the market swings wilder.
There's actually a really simple way to remember this whole chain of events. WHO, that's the dealers stuck with negative gamma, are forced to impact WHOM, that's the rest of us in the market, by doing what? By engaging in this crazy hedging that just makes big moves even bigger.
Okay, so we've got this dynamic, but what happens when you pour rocket fuel all over it? Well, that's where the recent explosion in one very specific product comes in. Zero-day to expiration options, also known as zero DTEs. The insane volume in these zero DTEs has literally created a structural shift in the market. I mean, check this out. One study on 2024 data showed the S&P 500 was in a negative gamma state for over 95% of all trading days. 95%. This isn't a rare event anymore. It's just the new norm.
So naturally, this massive change got a lot of people wondering, has this constant negative gamma somehow broken the VIX? You know, the market's fear gauge. The theory was that it was making the market seem way calmer than it actually was. But, like always, the real story is a little more complicated.
And the debate is pretty fascinating. On one side, you had people saying the VIX calculation doesn't even see all this zero DTE activity, so it's artificially low. But the other side came back with a really smart point. All this forced dealer hedging should actually increase real-world volatility, which in theory should push the VIX up, not down.
And when you actually look at the data, it seems to have a pretty clear answer. This chart shows the relationship between the VIX and what volatility was actually happening in the market. And look at those orange dots from 2022. They're right in line with the historical trend. The VIX wasn't broken, it was just correctly reporting what was going on.
Okay, so this is a super complex, kind of hidden force driving things behind the scenes, right? Which leads to this absolutely wild question. Could an artificial intelligence figure all this out on its own, without anyone telling it what to look for?
And that is the fundamental challenge here. How do you prove an AI is actually reasoning about market structure and not just memorizing something it read about, like the GameStop saga? You have to know if it understands the why, not just the what.
To solve that puzzle, researchers came up with this really brilliant method called obfuscation testing.
Essentially, what they did was give the AI a blindfold. They stripped out all the context. No dates, no company tickers, nothing. All the AI could see were the raw, naked numbers and the relationships within the options data. It had to reason from structure alone.
And the results were frankly remarkable. Even with zero context, the AI correctly identified these dealer hedging patterns nearly 72% of the time. But this is the part that gets really crazy. When the AI did successfully spot a pattern, Its predictions about what the market would do next were accurate over 91% of the time. That is not pattern matching. That is understanding cause and effect.
And this validation funnel just shows you how rigorous their process was. This wasn't a fluke or a lucky guess. The AI demonstrated a genuine, repeatable ability to identify these market mechanics as they were materializing, just from the raw data.
So, after all that, what's the outlook? What does this mean for the future of financial analysis?
Well, there are a few huge takeaways. First, we are clearly in a new market regime, one defined by this persistent negative gamma. Second, AI is developing some seriously impressive reasoning abilities. And for any risk managers out there, these kinds of tools could one day provide a crucial early warning system for amplified volatility. Plus, this whole idea of obfuscation testing sets a brand new bar for how we validate AI in finance.
All this research just opens up a fascinating new frontier. And it leaves us with a pretty critical question to think about. As machines get better and better at reasoning about these invisible market forces, who are you going to trust for your analysis? The human or the machine?
This is not financial advice.